Hi, welcome to Tabs 2 Cents. Today on the show, we have Shubham Garg. Shubham is the CEO of WhIte Tundra Investments, and he's a partner of WhIte Tundra Petroleum Limited. Today on the show, we're discussing oil. We focus on junior oil companies. Really hope you enjoy the show. This is a great one. We dig into Prospera Energy, that's ticker PEI.V, and I think Shubham really provides some great insight on this company later in the show. Hope you enjoy.
Welcome to Tabs 2 Cents, the show where we discuss multiple income streams and macro factors affecting the world today.
Hey, Shubham, welcome back to the show.
Yeah, good to be back, Joe. Thanks for having me.
Yeah, of course, anytime. I know you're a busy guy. I thought we could start the show. Maybe we could just talk a little bit about your WhIte Tundra investments and your latest venture, WhIte Tundra Petroleum Limited. Maybe just kind of expand a little bit of what you're up to for anybody who's watching, listening, and isn't necessarily aware of what you've been doing.
Yeah, you bet. No, 100%. So I think the WhIte Tundra investments, I mean, it began as just a portfolio of my holdings, and essentially we ended up kind of moving to more of a private equity / venture capital model. I don't know if there's a kind of like a proper term to describe it, but essentially going into some of the junior company investments and coming in as a group along with other individuals and call it entities in my sphere of influence, and we came in and took bigger stakes in some of these companies. So we started off, of course, in early 2022, and as that went on, I think we did our sixth one here kind of 3 to 4 months ago. And at that point, I said, you know what, six companies is more than enough. We have come in, we've taken 8 to 30% in those 6 companies, got a really good alignment with the management teams, very happy with the geology there. And if we as WhIte Tundra and partners are going to be supporting these companies through the engineering side, through the geology side, the business development, getting the word and the vision out there, there's really only so many companies that you can focus on. So we kind of close that off at 6. Doesn't mean that I'm not going to look at other opportunities. I'm always open. I get private placements and other information coming in every single week still. So still looking at everything. But for the most part, those 6 companies are kind of as they are in the portfolio. So once that was finished, we really had this vision in a sense that, okay, we should own and operate our own assets. If there's going to be so few people interested in this sector, if there's going to be so few people that are wanting to buy assets, that are wanting to control these small companies, that are wanting to go and start up new E&Ps, why not us? So I went in with my business partner, Phil, who lives in Lloydminster. I love having that field presence in the field when we're doing these sorts of deals, and essentially capitalized a new corporation and got our AER, Alberta Energy Regulator, Directive 67 approved, which gives us the approval to hold licenses for both producing wells and for mineral rights in the province of Alberta. So basically got that, about a 2 to 3 month process for that. And we're out here now. We have our first LOI on the first deal that we will be closing, in the process towards closing. And as we work towards that, just working on our due diligence and a lot of things here. I'm also learning as I go. So I've been involved, yes, in the operations side, been involved in the more financial side, and now more so in the, call it, entrepreneur side. So still learning some of the things that come with that. But yeah, essentially, I think I can share more maybe later in the podcast. But the way the company is set up is that we are really targeting the very small acquisitions. So we're targeting somewhere between 20 and 100 barrel per day assets. So assets that are kind of stranded, that are stuck in bigger companies and not really capitalized. They're not getting the right amount of care in order to maximize the net back of those assets. And especially if those specific properties have upside in terms of reactivations or in terms of new drilling opportunities, that's essentially how we want to do it. We want to start off very small, get cash flowing assets, roll them up, and then grow each one individually, where we can add 2, 3, 400% of production with just one drill, or maybe 2 or 3 or 5 workovers. So that's going to be the game plan going forward. And then, yeah, I guess we'll see where that takes us. But yeah, eventually our plan is to get much bigger, but through the drill bit, as opposed to through any sort of major acquisitions, which are getting more and more expensive. I'll put it that way. The market price of the asset on me buying the physical asset is a lot different than me buying that same asset through a company, which is why, of course, the investment case for these companies is so strong, given that the real price doesn't reflect what they're trading for on the public markets.
Well, that's amazing. Congratulations on moving into the business side from the investor side and almost going into sort of like an entrepreneurial or VC or however you want to set the term. And one of the things that I've noticed with you listening to some of your spaces and your content is that you always mention the geology. I wonder if that's something that you look at both when you're investing in a company and like for within a stock market, as well as some of these smaller companies.
Oh yeah, so 100%. When I look at companies that are in the public markets that are available through private placements, geology is definitely the main thing that we look at. However, before we look at geology, we need to look at the valuation. So if the valuation of the company reflects something that's way too expensive, then maybe we don't put in the work, because geology is not something where I can go and read 2 or 3 pages and all of a sudden I know the company's assets inside out. It takes hours and hours and days of work to figure out what kind of asset does this company actually have behind the scenes. So before we do that, we look at the overall valuation. So whatever metric you want to use free cash flow, you want to use net asset value, you want to use some sort of cash flow multiple of whatever it is. First, we look at that, identify the companies that are screening really well, and then go into the geology. Sometimes if it's a small junior company, we might go straight into the geology first because they have a very aggressive growth profile, or they have just an absolute gem of an asset that we can identify before we go into the other metrics. But either way, geology is a very primary component. When I look at my public market investments, it's something I spend a lot of time doing. You may have seen with some of my bigger holdings. I like to talk about them on my Sunday sessions or on my Twitter. Some of the new technologies they're using, some of the new drilling areas, some adjacent wells, some enhanced oil recovery for sure. And then when it comes to some of the smaller companies, I think this is absolutely paramount. I was just on a call yesterday with my production engineer doing a well logging analysis. So we went in there, we looked at 4 or 5 wells in the area. We said, okay, this well was producing from this zone, and then they plugged off that zone and re-perfed it into a different zone. Can we do those in the adjacent wells in this pool? And we kind of spent an hour and a half, 2 hours doing just that. So really spend time on the geology portion of it, not just from what's already obvious, but from what can we do in this asset to grow it from here. So some of the newer technologies like multilateral drilling, some of the new areas that are opening up in thinner zones with geosteering technologies and fish bones, some of the new areas that are now more conducive to enhanced oil recovery, all of that starts with your geology. You have to know what the rock is. We have to know what the viscosity of the oil is. We need the porosity of the rock, the permeability of the rock. We need to know, is it consolidated, unconsolidated? What is the initial oil saturation, the initial water saturation? And really that's how we do this basic analysis on what we have underground. Because once you have it, then we look at the fluid properties. Is it going to flow? How much of it can flow? Do we need steam? Do we need water? Is there inbuilt pressure within this reservoir? And then once you have that, now we can make a decision. Okay, is this property worth buying? And if so, how much oil is left in the ground? And over how many years are we going to produce it? So I'm a big fan of really doing the deep dive into the asset itself, not just, hey, there's a corporate presentation here that says we have 20 locations here. Okay, you might have 20 locations, but maybe somebody adjacent to you is drilling more closely, or is drilling longer wells, or is drilling a different style of well, and that all has to do with what they think the geology is and what they can extract. So I'm a big fan of right from the start understanding it from a reservoir level, and what kind of rock it is. And that holds true even for the properties that we're looking to buy. We focus on the geology, focus on reservoirs that are untapped, and we focus on reservoirs that haven't really been managed properly. They're injecting water, but the water is getting skimmed into some other zone, or it's moving into a part of the reservoir where we don't have a producer well. So these are opportunities that are not going to be obvious. You have to put in the time, and that's why the market is so great now, because there's so few people that are putting in the time looking for these sorts of upside opportunities within assets that are already out there. There's a lot of information on these assets already out there. It's just a matter of, you got to know what you're looking for, and then you got to go and do it and see what happens.
Yeah, I think that's great. I brought that up because oil is one of those sectors that it's kind of like the more you know, the more you realize you don't know. And you were one of the people that sort of brought that term geology and the significance of it for the assets to me. And it's interesting because the sort of a general knowledge within investing, like for individual investors, is that you may be more likely to find more opportunity in smaller companies and companies with small market cap, because it's not necessarily where a fund's going to go. Like, they have too much money, they're going to raise the stock price too much if they buy the amount they would need. So it's interesting that it's almost like a tiered system. You got your mega cap oil, you got your mid cap, small cap, and then you've got these 50 to 100 barrel assets that you're looking at. And I would have to think that there's probably even more value in that area, seeing as it's private. And it brings me to a recent space that you did. It was a case study on junior growth of the past. And I know before the show, we sort of discussed that it sort of shapes a little bit of your investment philosophy. I wonder if you could talk a little bit about that space and a little bit about how the historical growth in junior companies have kind of set a framework for you.
Yeah, for sure. So I think this is going to also tie back into the geology discussion. So it's a nice segue into this. But really, when I look at what are we doing here, what are we doing in WhIte Tundra Petroleum, what are other junior companies doing today? They're not doing anything different than what the junior companies did in 2012. They're not doing anything different than what the junior companies did in 2000. Not doing anything different than the junior companies 2015. But there's very, very differing value propositions that were created. There's differing levels of increase of money that was made by the people running these companies and the investors in those companies. So what was the reason? The main two things that really mattered were the price of oil. So we start off all of this, we talk about what is the price of oil going to be when you bring that barrel out of the ground? What can you actually sell that barrel for? Because once you know what you can sell that barrel for, you know how much money that barrel is going to make on a profit basis. The other thing that was kind of changed is, what valuation are you buying that barrel for? So let's say there's a junior company, they want to go and buy 1,000 barrels somewhere, and they are okay with paying 10 times cash flow at $100 WTI strip. Versus today's market, assets are out there, good assets, you might be paying 3.5 times cash flow on an $80 strip. So your entry point and the price of oil once you enter those assets is really the only differentiator between very, very successful companies and companies that go bankrupt doing the exact same model. So what I really wanted to get across with their session last week was exactly this point, is that the market has always been there. The way to do business in this industry has always been there. Yes, there's changes in terms of the way asset retirement obligations are looked at. There's differences in the way that money can be taken, your cost of capital in the industry. There's slight differences for sure, but the overall overarching mission or model is the exact same. So when I went back and looked at these companies from 2008 to like 2016, 2018, I found that what they're doing is there's so many properties that in 2012 to 2014, new technology came on the market. We saw the advent of horizontal drilling in heavy oil. We saw the advent of water flooding in heavy oil. We saw some of the changes into multi-zone and multilateral drilling. So all these technologies came on the scene, and the junior companies had the assets. They had all these lands. They had run 3D seismic. They had run maybe just 2D seismic. They had drilled vertical coring wells. They had the cores. They had the analysis. They had the fluid analysis. So what went wrong? Well, the only thing that went wrong is, once again, oil price. So those assets just sat there and sat there and sat there. The company, some of them survived for 1, 2, 3 years, and then they went under. The cycle drawdown was so elongated that most of those companies did not survive. And those assets ended up transferring through receivership. Sometimes they got bought out by a bigger company, and they just sat there untapped. Why? Because those are small assets. If something is only going to make, let's say, 500 barrels or 1,000 barrels at max, it's currently making 200, but that asset ends up in a company that's making 100,000 barrels. Are they going to put their engineers and geologists and geophysicists to go and further develop that asset? Probably not. It's just going to sit there and wither away. And those are the exact assets that today are still available on the market. They're still sitting there, some of them untapped. There's also assets that were never identified. So there's drilling that happened in the 1980s or 1990s. The asset died away. Some of the wells were abandoned. That asset never got horizontal drilling. It never got heavy oil water flooding. It's still sitting there in that same pool, and you can still go in and get those barrels out of the ground. But those assets were never properly, delineated or studied, even in 2010 to 14. So that's really what gets me really excited about this cycle, is that we have two things behind our back. Exactly what I discussed at the beginning of this question. We are staring into a structural undersupply bull cycle. So we've solved the oil price, call it concern. Now, of course, you have to believe that. If you don't believe it, you probably should not be buying junior companies or starting E&Ps anyway. So you have to have that inner belief, and backed up by fundamentals, backed up by data, backed up by supply-demand analysis, that we are going into higher oil price environment. We also need the valuation to make sense. So right now, if these assets have gone from 500 barrels per day over the last 7 years, they've withered away to, let's say, 100 barrels per day, you're essentially paying for maybe 1/3 or 1/4 of the production that you can get it back to, and you're only paying 3 times cash flow, and you might only be paying that at a $70, $72 WTI strip. So those two things have combined to be in a very, very good position here. And really, when I was doing my research on some of these companies from the last 10 years, 10 to 15 years, that I presented there a couple Sundays ago, that was the big enlightenment that I got. There was always this a fact that, okay, there's some assets that haven't been developed, some assets haven't been properly produced, but I really got to realize that, wow, it's not just 1 or 2 assets. This is every single junior company that had the exact same story, and they weren't able to develop the assets. So really, that was a big eye opener for me. Is the people that are running these companies, they weren't stupid. They weren't unlucky. They just made a fatal mistake on the price of oil. They made a fatal mistake on the valuation that they were willing to pay on the acquisitions, and that's it. So if we can control those two things, we can have a lower entry point, as well as have hopefully a better oil cycle that we're investing in. The model stays the exact same. And I am going to do a part 2 of the junior companies deep dive as well. Junior companies of the past deep dive, because I just find it fascinating that when you look at the history, we are saying the exact same things today that we said 10 years ago and that we said 15 years ago. It is uncanny, the kind of similarities between the two. And every oil cycle, there's the people who don't believe you, and those are the same people who sit there and cry because the people who believe the story ended up making multi-generational wealth. So not investment advice, it's just using case studies to show you what happens in an oil bull cycle.
Yeah, for sure. And it's interesting because you practice what you preach in some ways. And one of the companies that I actually own as well, that's in your WhIte Tundra portfolio, it's 15% of your WhIte Tundra investment portfolio is Prospera Energy. And that's ticker PEI.V for anybody who's interested. And this is a company that has a market cap of $30 million. So we're talking about a very small company in the grand scheme of things. And I wonder, I'd like to discuss it a little bit as an owner myself, and full disclosure, but just for anybody who might be interested in a junior oil company, what makes Prospera attractive, and what are some of the characteristics of that company that investors could look for in other companies as well?
Yeah, for sure. So I think I should also provide a full disclosure. Definitely a major shareholders of this corporation. We participated and actually we're lead investor in the non-brokered private placement in January 2023. So this is not something that I've accumulated on the market. This is something where I went to management and I said, look, I really like your assets. I love the geology. I like what you're doing here, the growth profile of this corporation. We want to come in on a non-brokered private placement to this dollar amount. We don't want to over dilute the company. We only want to bring in this dollar amount so that we have a major enough stake in the growth of that company. So a company I've followed for about 18 months now, didn't really participate, bought a few shares on the open market, but then really got in with this private placement. So what do I like about Prospera? So there's things have definitely changed over the last year or two. So maybe a bit of history and then kind of where we are now. So the main thing is we have oil in the ground. So we got the geology. We have 400 million barrels plus of oil in the ground, of which only 8% has been recovered. So this is a very technically challenging reservoir. So I'll get that out of the way right in the start. So when I talk about Prospera with certain people, with people who were around in early 2000s in the Canadian oil patch, in the 2010s in the Canadian oil patch, I just immediately get this look of disgust because they know the assets are very technically challenging. There is lots of interesting issues here that other pools in the area don't have. But guess what? The other pools in the area have 25, 30, 35% recovery factors. Most of that easy oil to produce has already been produced. It's already been water flooded. It may have already been polymer flooded. Just so for the viewers that don't know, a maximum recovery factor you will get to is somewhere like 35 to 40%. That's after secondary and tertiary recovery and sort of infill drilling, horizontals, everything. So when I say these assets are already at 25, 30, 35% recovery, they're basically end of life assets. You can't grow them. They just stay where they are. You might get a few barrels, squeeze them out here and there. But for the most part, you're in a blowdown phase. These assets that they have, yes, they're more technically challenging, but they have the oil still remaining to be produced. And what was I just talking about 10 minutes ago is we have the new technologies to produce these kinds of wells. The zones that were very, very difficult to drill into and keep your drill bit straight, those we now have the technology to keep our drill bit better, more in zone. We can drill longer horizontals in these same heavy oil reservoirs, and we have polymer floods along with nanotechnology, which is able to extract more heavy oil. So the problem with water flooding in heavy oil is water is so much less viscous than heavy oil. So you go in there, you inject water, but what does the water do? As soon as it finds a path of least resistance, it just keeps flowing past the oil. You put in the polymer, it blocks the water from doing that. You put in the nanos, it really extracts the oil off that rock, which heavy oil wants to stick to that rock like it's going to die if it gets pulled off. So, which it will. So essentially, we have these new technologies that are being slowly tested. Prospera was a company that was 5.5 feet under the ground in 2020. It got brought out of the ground slowly. They had that casket lowered. And Prospera was in there, and they said, no, hang on a sec. Let's bring this back up. So they slowly brought it back up. In 2021, they cleared up a lot of the unknown debt. They cleared up or unpaid debt. They cleared up some of the liabilities. In 2022, they ended up raising some money from two very, very strategic businessmen, not investors, businessmen, brought the company more out of the ground, drilled a couple of wells, which were sidetracks. One well made about 40 barrels per day. It's been making 40 barrels per day flat for many, many months, other than the winter where it went down. The other well, unfortunately, got junked. So as they were going in, there's an area there where too much oil had been extracted out of a vertical and the formation collapsed on itself. So again, very technically challenging reservoir. So that was 2022. They slowly bringing the casket up. And then 2023, they did the private placement with us. They did a multi-million-dollar debt financing. And then they had warrants getting exercised, bringing more money to the company, into the coffers. They kept working on reducing the liabilities. They kept working on increasing asset value. They kept working on adding barrels and making sure everything is working good. And they kept working on eliminating extra operating expenses. So extra surface leases, there's extra electricity being used somewhere. You have extra pipelines all over the place. Removing all that, getting a much cleaner operation. And here we are today with a 18-well drilling program beginning as early as next week. So planned for in the next couple of weeks. They said mid-August. We'll see when that drill rig actually ends up on site. But really, we have an 18-well program now on a company that's on the ground. So the opportunity to me is, okay, now we finally see not a 2-well program, with an 18-well program, what the reservoir can do. Each well that they drill, we will have learnings. Okay, maybe this well was too long. Maybe there was a water zone here where we ended up going into. Maybe these wells need to be placed a little bit deeper in the reservoir. Maybe the wells need to have a different kind of steerable system. Every well that goes by, we get more and more learnings, and we get more places where we can get the oil out of. So that's essentially the story in a nutshell. What else do I like about it is the growth profile. So the company was at about 100 barrels per day in the depths of COVID. It's now up to about 750 to 800 barrels per day net to them today. So about 8x up in production. And the 18-well drilling program at very, very conservative numbers, assuming all the wells pan out, is expected to at least double production from here. So that is the first stage, but that's not the end game. The end game is, if the wells are successful, there's now 350 million barrels left in the ground still to produce. So we keep iterating this process over time. We keep growing production. And one of the best things about this company is the facilities are already there. So when they produce the 8%, which is roughly 40 to 50 million barrels out of the oil that's in place, the previous companies that own these assets had already built massive facilities. So everything is there. There's no money going to be spent on facilities. We can just go in, drill the wells, produce the oil, and we're off to the races. So I think this is we have performed the rescue operation. We have gone in and given the rescue patient water and food. Now we see, can the rescue patient get up and actually start going out there and doing some bench press and doing some dumbbell raises. So that's where we are, and we're on the cusp of that. So geology, oil in the ground, new technology. That's essentially the basic way of describing them. And yeah, looking forward to see how these wells pan out.
Yeah, definitely. It sounds like there are some opportunities for this company in the future. And it's interesting because the last time you were on the show, we talked about Surge and Meg, which are also two great companies to look into. But I did get a lot of comments saying, I can't believe you didn't talk to him about Prospera or how do you say it? Anyways,
Yeah, Prospera,
Prospera, yeah. So
Mhm.
I wanted to bring that up, and it sounds like another kind of benefit to this company is that it has a bit of a stigma attached to the wells, and perhaps there's a bit of a narrative going on with them. And I know a lot of the time in the market, when companies kind of are looked at that way, they're perhaps trading at a a more than fair valuation. Do you think that it's safe to say that this could be one of these companies that needs to prove itself again, and that's why they're valued where they are?
Yes. Oh yeah, 100%. There is a show me story here for sure. One is on the management team, because yes, they have executed over the last 2 years, but there is, okay, well, you guys junked one well and the drilling program has been delayed a couple of months. So it's like, what have you done for me recently? That becomes a question. So there's that part of it. And then there is the, call it narrative on the assets. And I found this to be true, not just with Prospera, but with many junior companies I'm involved in. People look at it and they say, you're buying what exactly? So the reason they say that is because, number one, their mind is still in a $50 to $60 oil environment. They looked at these companies when it was 2015. They looked at these companies when it was 2017. Their mind is still running calculations as if the price of oil is $50 to $60 per barrel. Okay, which it was. From 2015 to 2020, 6 years, the average price of WTI was $50 a barrel. So they're still stuck in that mode of thinking that, hey, at this price, this asset makes no sense. Okay, well, we're not in that price anymore, and we are investing or betting on a much higher price going forward. So things change quite a bit when you bring that into account. The other thing is the asset itself. So when somebody works on some asset and they're unable to get really good results, or they hear about the company unable to get good results, they say, oh, that asset must not be a good quality asset. Okay, fair enough. It's been 8 years. It's been 10 years. We have much, much, much better technology that's out there right now to go into those assets. So whether that's actually going to be proved in terms of more production, that's what the company has to show us. So you're exactly right. It's a show me story. And I don't blame the market participants for thinking that way. I think that's a completely reasonable way to look at it. But guess what? Once the information is out there as to how these wells did produce, let's say they end up producing at the rate or higher than the rate that we're looking for. Well, then the opportunity to invest in it and make money on that inflection point is gone. So that's kind of how I see it. Is when I see something where the odds are tilted in my favor, I'll go and take that bet, especially when that bet is something I can go and vet. I can go and see what's going on. I can go and look at adjacent wells and adjacent pools and see what's worked and what hasn't. I'll take that bet for sure. But hey, that's what makes a market. There's people who are risk averse. They want all the information out there by the time they get ready to decide to make an investment decision, and that's completely fine. There's nothing, there's absolutely nothing wrong with it. I just choose to run my portfolio with a more aggressive manner because the information is out there. We're not out here betting on like is this rocket going to reach space or anything. We're betting on something where the data is already there. When there's other companies drilling in the same area using the exact same methods, just a year or 2 or 3 ago, we can tell, okay, there's some merit to the madness here. And yeah, but at the end of the day, the results have to come out. And I think that's the greatest part, that we are on the cusp of that drilling program. So yeah, not long to go now. I think we've been patient for a few months. So off to the races very soon.
Yeah, hopefully for you and me both with this one. One thing I do wonder about as far as risks with some of these companies is the regulatory environment that they work in. Do you think that the junior companies are under a little bit more pressure, just given kind of the push for net zero and carbon free and all these things that are going on? Are they under a little more pressure than some of the larger guys? And what are they doing to kind of work with that, or kind of, prepare for what could come soon, especially, in Canada?
Right. Yeah. So I guess there's two answers I'll give you to that. So I would say that the majors are more risk from some of the net zero and emission reduction targets, just because there's more of a bullseye on them. They're just bigger. There's a target. they emit more because they produce more barrels. So they're just a bigger fish to fry from a government, social, and investor perspective. Okay, if we can knock out these guys and take 40% of their emissions out, it makes a much bigger difference than a junior company and knocking out 90% of their emissions. It's night and day, right? So I think from that standpoint, some of the bigger companies are definitely more at risk. What are the junior companies at risk of is regulatory risk. So any changes in terms of your liability ratios, any changes in terms of asset retirement obligations, and how much money you must spend on cleaning up your wells, how many inactive wells and facilities can you really have out there, how much reclamation must you do every year. Those are the risks that affect the junior companies the most. Certain companies have gone under because of regulatory risk. It's not that their barrels weren't being produced properly. It's when their barrels were making money, but all that money was going towards reclamation and retirement and abandonments, which ended up creating the problem. So what are they doing to prepare? So there's companies out there already in the junior space that are overdoing what they need to do. So they might have a liability ratio that's lower than what the recommended limit is or the required limit is. They've been going in and over abandoning wells. During 2020, 2021, we had the SRP program in Alberta, the site rehabilitation program. They applied to that. They got a lot of grants to go and abandon a lot of these wells. They went in and found ways to reduce their liabilities. And one of the ways to reduce liabilities, reduce your liability ratio or increase your liability ratio, which is deemed assets over deemed liability. One of the ways to increase that is to just have more assets. So as prices go up and you reactivate more wells, you have less wells that are suspended. In essence, your ratio goes up without really having to reduce the denominator of that calculation. So they're working on things like that and really cleaning up the facilities that they have right now. So there's a lot of low-hanging fruit on some of these assets that the junior companies have, because the same way they never got the care in the sense of increasing production and optimization and really lowering operating costs, they never got the care on the reclamation and environmental side of things. So a lot of low-hanging fruit that can easily be fixed that they're working on. And really, when I think about regulatory risk on these junior companies, I once again look at low oil price. So at an $80, $85 oil price, when there's plenty of cash flow coming into these corporations, they're making lots of extra money. It's really not something that bothers me at all. When we talk about a $50 oil environment, $60 oil environment, some of these companies, even if they have low debt, okay, there's there's less financial risk, but now the regulatory risk comes back into play. And that's really, I think, what investors should be mindful of. One comment I will make, though, is if the companies survived 2020 and 2021, think about what it would take in order to crush them now. So just always keep that in mind. We see people making all sorts of false claims about the bankruptcy risk of these companies or the regulatory risk of these companies. Think about that. They survived 2020 and 2021. Some of these companies survived 6 years of $50 oil price from 2015 to 2020. It takes a lot more to take the companies that are left under than maybe what is being portrayed or what the narrative is showing out there.
Yeah, absolutely. And I think at the end of the day, what it all boils down to is oil price. And I know you mentioned that a couple times. And I thought before I let you go, we could just talk a little bit about oil price. And especially because we just got the US crude oil inventories and it was, a mega beat. We had 17 million and the forecast was like 1.37. So, it's kind of like surprising for a lot of people. And I wonder if we just talk a little bit about the macro before I let you go. I know you've got your eye on a whole bunch of unique things that since the last podcast that you like to talk about. So we should just talk about that quickly, just for anybody who's kind of wondering, like, okay, This sounds like a great investment, but what about the oil price? What if it goes down to 50 again? What's going to happen? And what's your thesis on the price moving forward?
Right. Yeah, sure. So we are in a good range right now. So not for my investments, not for what I would like the price to be, but we are in a good range here where you're not seeing supply get absolutely hammered, and you're not seeing demand really get supercharged. We were in that range for 6 months. When you put oil into the high 60s, low 70s, you bring that crack spread down to like the mid 20s, high 20s. We saw supply was starting to get impacted, and it still is. There was supply, especially in America, that really got hurt. Is going to play out over many months from here. So the U.S. shale production, okay, it grew in 2022. Yes, oil price was very high. We still had the rebound from COVID. We had the DUC wells coming off, and then we had such high pricing that rigs were going into all sorts of counties and just drilling wells. So we're back down from there, obviously, but we swung the pendulum too far. The pendulum swung to the point that certain private companies got taken over. They dropped all their rigs and they got taken over. Some of the bigger companies, they had announced, oh, we got this much yield and we're going to give you this much dividend, and then they got shellacked. So with all those factors playing into it, they had to reduce the amount of capital that they were spending into keeping production flat or growing production. The rig count started dropping. Some of the companies in the non-core of the Permian really suffered, still suffering, and that's going to play out over time. When you drop a rig, it takes 2 months for that well that the rig drilled to get off the DUC and be on production, maybe 2 to 3 months, and then really it's a longer term effect, how that plays into it. So to kind of bring that point to a whole, is we're seeing supply drop in the place where people expected it to grow the most, which is America. So the other supply in the world, that red panic button was pushed in 2022. Excess supply, your surge capacity came online in places in the Middle East, in Canada, in Mexico, in Brazil, etc. That button's been pushed. On top of that, 250 million barrels got released from the US SPR. So that button got pushed. You're firing your insurance bullets. So we sit here now and we have one insurance bullet left, OPEC. So OPEC is the one that cut the barrels here in March and then again in May and June. And that's now your spare bullet left. But that bullet doesn't want to be fired. They don't want to fire that bullet unless we absolutely need to in a global scale, or the geopolitical requirements of the world dictate that bullet be fired. So you have an entity that's controlling your final insurance policy, that wants higher prices, that is looking for higher prices, that is very cohesive. At the same time, you have a global economy that just will not stop consuming petroleum products, despite all the manufacturing is going to collapse and real estate is going to collapse. Fine. Global oil demand continues to hit all-time highs and is growing at an even faster pace. We have to remember, in the 2008 recession, global oil demand didn't just come back on its regular path. It came back and it made up for the loss during the great financial crisis. So why would it not happen again? That's usually the way things have gone in the world. So as we see that resurgence in demand, we see the supply in the world is overall okay, but really US shale is not looking good here. We've already flatlined on the production. Are we going to see production declines right away? We'll see. We're trending that way, but we're not quite seeing that yet. But let's be honest, at the beginning of the year, every major analyst was predicting 600,000 to 800,000 increase in US shale this year. So just the fact that we're flat, we've already lost 600,000 to 800,000 barrels of the supposed growth that was going to occur in the US. So we don't need this thing to fall off a cliff just to prove the point that the US shale can't grow anymore. We just need it to not grow to that extent, which is proven at this point. I just saw a Goldman Sachs report this morning where they're only expecting 80,000 barrels now out of the US in 2023. So think about that delta. We lost all that supply, essentially putting the key in OPEC's pocket, and that key is not going to be used until it needs to be used. So that's where I see it. We are kind of at a standstill right now, where I think there's too many factors that are restricting oil from going up. So although we have the undersupplied market, a lot of the inventories are being drained from the excess. So as that excess comes down, as we see more and more participants willing to speculate on the price of oil, that's really going to be what pushes this up. And I believe we're right in the midst of that. We were talking about second half of 2023 being that. July, we saw crude draws mostly on the oil on water side. So all the transiting oil got drained and some of the floating storage got drained. This month now, we are into as you mentioned, the onshore crude draws. And as that continues, we're going to hit a point where you can't find that barrel. So you have to be willing to go and speculate on that barrel. And that's really going to be our next leg up. After that, the jury is out as to what we will see. There's a lot of conflicting information out there. Is China going to release barrels? Is OPEC going to go and add those barrels back in the market? We don't really know. So as we get to those points, we will sort of rethink where we're going from there. But one singular truth holds true. Demand continues to rise. At the same time, supply is not rising. Especially when you take the US into the equation and what they were supposed to do, supply is not rising. What does that tell you? That tells you have a wedge, a extra wedge that's just getting smaller and smaller. And once that wedge is removed, well, now you have no SPR. Now you have no DUCs. Now you don't have that surge capacity because you already pushed that button in 2022. And therefore, we will find what that final barrel in the world is worth. It may take a little bit of time. And that's why we're now in a cyclical investing thesis. 2021, 2022, WhIte Tundra was still investing in a lot of the bigger names, a lot of the small to mid caps, in order to make that money and then find a place where it makes sense to exit. At this point, I think that's why we transitioned to more of a junior company game, because that's where the juice is on a cyclical investing thesis. So more than happy to be patient here. And let's not kid ourselves. This is going to be a very volatile trade, extremely volatile. The entire world wants cheap oil, and there's maybe 5,000 or 10,000 of us oil investors in the world that want expensive oil. So we're literally betting against the world, but we're also betting on the world to keep consuming. So I guess we'll just keep betting on that thesis and see where it takes us. But I'm definitely bullish on the sector. I've always been bullish oil price, but I do think that the 6 months that were in the too low oil price has now created an even more tailwind behind our back. But that tailwind is going to take longer to play out, as opposed to this massive ramp up all of a sudden once again.
Yeah, absolutely. I think that's a great sort of overview of what's going on. And I do wonder with the juniors, are they comfortable at $80? Is that if we remain, $70 to $90 for the next 4 or 5 years, are these companies going to be able to break out and succeed, or do you think they need higher prices?
So there's a big difference. At $70 oil, no. They will really just be treading water. Can they grow production a little bit? Yes. But really the thesis will not come to fruition. At 80, we grow a little bit more. We're able to accelerate some of the projects, but really the thesis still doesn't come to fruition. At $90 oil, okay, now you're generating so much cash flow out of your assets that you're able to re-put that dollar back into the ground and keep producing more and more oil. And then everything on top of that really is just gravy, meaning that the higher the price goes, the faster you can accelerate your projects to get that oil out of the ground. A couple of points here. The junior companies are not going to add enough supply for it to be meaningful. So even though they're growing even faster at a $90, $9,500 oil environment, it's not enough barrels. It's only 1,000 or 2,000 or 3,000. It's really not big in the grand scheme of things on that side. And then the other point I was going to make is I just lost it here, but something to do with the junior company. So if it comes back to me, I will mention it here before the close of the podcast. If not, I think that's kind of where I see it. Is really we need higher prices. These companies, I'm not investing in these companies for a $70 to $85 oil environment. We're investing in them so that they can grow production and keep growing production. Oh yeah, I got it. So some of these junior companies, because their cost of supply is higher, as in they have higher operating break-evens, what ends up happening is, let's say they make $2 a barrel or $5 a barrel at $70 WTI. At $80 WTI, they make $12 or $14 a barrel. So they've essentially, with a $10 change in WTI, aka 15% change in WTI, they've 3x'd their cash flow, their cash flow after all the expenses. At $90 WTI, they maybe make $20, $22 a barrel. You can see how the torque on these companies is a lot more because they have a higher cost of supply. So I get both ways to invest. You can either invest with a lower cost of supply, which means you're protected all the way to the downside. Our strategy here, we've moved to investing in a higher cost of supply, because as that price rises, you get that multiplier effect on it, which doesn't exist in some of the lower cost producers.
Why wouldn't that exist in a lower cost producer? Why wouldn't a mega cap be able to 2 times their income the same way, just based on their profits per barrel? I'm just curious.
Right. So basically, let's say the price of oil is 70, right? We can run through the same example again. So let's say the price of oil is 70, the mega cap or your blue chip company is making $20 a barrel, let's just say, for argument's sake. But your junior company is making $5 a barrel because they have a higher cost of supply. When WTI jumps to 90, the mega cap goes from making $20 a barrel to $40 a barrel. Just easy math. So they doubled their cash flow. The junior company goes from making $5 a barrel to $25 a barrel. Just add 20 to each. So now you 5x your cash flow. So the dollar amount is the same that they make extra, but the multiplier on it is a lot more X in terms of cash flow. And people usually in the oil and gas world run cash flow multiples or free cash flow multiples. So as that cash flow goes up, not only should your multiple, as in your share price, increase, but also you're making way more money. So now you can use that money and put it back in the ground, whereas the bigger company was already doing that, or they were paying it off in dividends or buybacks, whatever they were doing with the money, they were already doing it. The smaller companies, they can finally make money at 85, 90, and they just get extremely juiced up, especially if they can grow production as well along with that. Just fantastic. Yeah.
Perfect. Yeah, no, I get that now. I completely understand. And it actually brings me into my last question I have on the macro for you. And it's related to the US dollar, because I know that the US dollar can have a big part, because a lot of these oil contracts settle in USD. And it's interesting because it's a little bit what you just described with the profits on per barrel is a little bit like the interest rates that the Fed have increased. And what I mean by that is, back in the 80s, they went from, 10 to 20%. And that's, a double. Whereas this past year, they went from, 0.25 all the way up to 5.5. So, multiple X. And I think that the impact is going to be much stronger, even though it's a lower amount of increase on a nominal basis, because, as you say, the multiplier. And I do wonder if they're already sort of predicting next year that they're going to potentially cut rates. And if you start to see the Fed cutting rates, the impact on the dollar, it could be weaker. Do you think that will raise the oil price, and what kind of an impact would that have, or raise or lower the oil price? What kind of impact do you think that would have on Canadian companies and US companies as well?
Yeah, so I haven't really thought about it that much in detail. the way that I kind of see it is when we come back to the oil price part of things, historically, the higher the dollar goes, as in the stronger the dollar gets, usually the oil prices get weaker. Didn't really see it this time around. I mean, we saw it to some extent, but not to the same really level. As that dollar gets weaker, let's say it does. I'm not saying it's going to, but if we assume that theory, the dollar is going to get weaker, it obviously becomes cheaper for some of the other countries in the world to go and buy the oil, with those other countries being the ones that are really your growth engines in terms of oil. But I think, not to say that this is a fact, a complete fact, but just what I think is other countries are realizing, or they've already known this, but they now are walking the talk, in the sense that they realize how important petroleum is to their growth and to their livelihoods. Like we should not forget that oil is just such a damn good product that you can go so many miles and do so much work on a single barrel of oil, that really, it doesn't matter if it's $58 a barrel in their currency to them, or it's 62 or 65. It's really not a big enough difference for it to matter if somebody has made the decision to switch to oil from whatever they were using either way. So I think the impact of it is just getting less and less as the other countries get richer and richer on a GDP basis. So that's my one view, I guess, on that. Just something I'm just thinking about right now, off the top of my head. And then the other point would be the Canadian companies. So as the dollar gets weaker, the Canadian companies are definitely going to suffer a little bit, because they are selling oil in the US dollar, but then you translate it into Canadian dollars and they're getting a lot higher price per barrel than if the dollar was at par. So this is something that has been a big tailwind to these producers. They have been able to buy back way more shares and pay much higher dividends over the last 12 to 24 months, because they're getting essentially a 30 to 35% boost in terms of the price of oil that they're getting. So how does that change over time? I think if the dollar gets weaker, you will see a bit of a lower cash flows, obviously, to these companies, assuming oil price stays where it is. But at the same time, I just don't think that we're seeing that sort of tailwind anymore. Like for us to get back to par, the US economy would really have to degrade against the Canadian economy. And is that going to happen? We don't really know. So if we do get to par, I guess, let me put it this way. If the dollar does get to par with the Canadian dollar, yes, the Canadian companies and their cash flows will go lower. But that's not a kind of a scenario that is being modeled right now, just given how strong the dollar has been, and the fact that the Canadian economy itself doesn't seem like it's supercharged by any means, or firing on all cylinders. So we'll see the impact of that play out. For now, we'll enjoy the extra 30% gain while we have it. And yeah, I guess we'll revisit accordingly. The one nice thing about this entire conversation is that, other than the foreign exchange, the Canadian producers have so many other benefits over the US producer that it would require a absolute catastrophic collapse in the US dollar in order to go and switch back to US companies for any sort of reason that's related to foreign exchange.
Yeah, no, I think that's some great insight there. And yeah, it's just such a large, complex picture when you get to the dollar. So I apologize for throwing that at you, because I know that it's, almost an impossible question to answer. But I do think that it is important to understand some of the relationships between the US dollar and Canadian companies and oil in general in the market, because it's kind of a give and take when you look at a lower oil price, but also a stronger dollar for Canadian companies, because it's kind of, if the oil is going down because the dollar's strong, Canadian companies can still do well because they have that FX, as you say. So yeah, no, that's great. And yeah, with that, we can wrap it up here. I don't know if you want to just let any listeners know where they can find you. Where I found you was on Twitter, And I love the spaces you guys do. They're always super informative. And I don't know if they're, WhIte Tundra Petroleum Limited, if there's any kind of options for, interested investors where they can contact you, or even WhIte Tundra Investments. So I'll just give you, an opportunity to share or talk about any of your content or anything like that.
Yeah, 100%. So I'm mostly on Twitter, so at WhIte Tundra SG. You can also find me on my website, whitetundra.ca. My email is on there. We got a little contact form, so feel free to email or DM if you have any other questions on sort of that side of things. And then yes, I do Sunday sessions, so probably twice a month now, completely free, and you can see the schedule on my website. I think I'm gonna take probably a couple of weeks of break here, so the next one probably August 20th, if I'm not mistaken. And yeah, all sorts of topics. We talk about valuation, companies, geology, petroleum engineering. We talk about oil and gas macro, some of the factors that are affecting the kind of trade, and various different junior companies these days is kind of the theme of the summer for now. So all of those are also on YouTube. Again, at WhIte Tundra SG. If I'm not mistaken, that's where the YouTube handle is as well. And then yeah, we're unfortunately or fortunately we're completely private. So WhIte Tundra Investments doesn't accept outside investment, and then WhIte Tundra Petroleum is self-funded between myself and my business partners. So yeah, I'm hoping at a future point in time there's maybe ways to collaborate and get interested people into the entity, but I think for now, given the risk profile of what we're running and the requirement for complete, call it autonomy and control, we've just chosen to run the entity this way. But yeah, happy to answer any questions other than that. Or yeah, I guess I'm also active on Twitter Spaces, as you mentioned. So if anybody has any questions, feel free to hop on there, and I could chat oil 24/7. So let me know, and we'll go from there. And yeah, thanks again for having me.
Yeah, absolutely. It's always a blast. And good luck with your future endeavor. Hopefully it works out for you, and maybe we'll see it going public someday. Who knows?
Yeah, no, thank you. Cheers.
Joe is not a financial advisor and may have interest in the stocks discussed on the show, so do not take any information included within this podcast as a recommendation or formal advice. Thank you.